Manish Gunwani is here with us, CIO at Bandhan Mutual Fund. Manish, good to have you. Nice to see you in your new role. My best wishes. So let's start our discussion with the most spoken about sector this morning, that is IT. It is interesting to see that it's not taking incremental knock in trade. But for the moment, if you would have just read the commentary that at least from TCS saying hardly any visibility for the second half, all of that, even HCL Tech commentary seemed to be suggesting that things are not looking that rosy yet. But the street had started accumulating those counters. What's your positioning on IT? Would you be a buyer from any weakness from here on?
So overall, we're still underweight IT. The thing is, I know from a free cash flow perspective, these stocks are looking incrementally attractive. But the thing is, we still haven't seen how big and deep the US slowdown will be. The second is, if you take on a 4-5 year basis, the valuations are not necessarily distressed cheap. They've corrected a lot in the last 1.5 year. But it had been one of the best performing sector from 2017 to 2020. So if you take long-term valuation stocks are not necessarily very, very cheap. And thirdly, we're definitely seeing the dollar under a lot of pressure. And there is a possibility that if the dollar remains weak for some time, and we see a fairly extended period in which rupees stays flat or maybe even appreciate, then I think the pressure on margins is likely to build up. So given all these positives and negatives, we still think on balance, underweight still makes sense.
Okay. So most undervalued, or rather, you're negative on IT still right now, Manish, but where would you say that there is value on the table and that sector should be bought if you spot anything right now?
So I know, again, that the domestic cyclical sectors like auto, financials, industrials have done well. But I mean, just think that the momentum in the domestic economy is likely to be much stronger than the global economy. So from a broad top-down perspective, our view has been that the domestic facing sectors will outperform the global facing sector like IT chemicals. So to that extent, we still are on that theme. I know the valuations have become more expensive in the domestic sector and relatively corrected in the global sectors. But clearly, I think one of the most fundamental drivers this year is the trajectory of the dollar. As we're seeing, it has corrected almost 13-14% from the top, the dollar index. And I think a lot of the strength in the dollar has accumulated over the last 10-12 years. And while macro forecasting is always risky, my hunch is the dollar is likely to remain weak. And in which case, as I said, the export sector not only will have a top line issue, but I think going forward, it could be a margin issue as well, because if the dollar is weak, your realizations obviously suffer.
You seem to be bullish on the domestic stories here in India in the economy. What about PSU banks? We are seeing early sparks of a second round, which is starting in the PSU bank space. After 2-3 good quarters, they went sideways. Despite of good earnings, the market was kind of ignoring them. Are they back at attractive valuations to nibble in, PSU banks, especially the mid-tier ones?
So again, our exposure today is much less than, let's say, a year back. And the logic is this, that clearly we are in a situation where the global economy can slow down from here. That will have an impact on the Indian economy as well. Now, banking as a sector obviously has again done well last 2 years. If you see the aggregate ROE or ROA of the sector, it is almost at a decade high. And in that scenario, not only with banking, I think across the market, we're trying to remain in slightly higher quality names within each sector. So yes, we think the domestic cyclicals are attractive versus global cyclicals, but within the domestic cyclicals, I think you need to be a bit more selective. See, from COVID bottom, obviously, almost every cyclical is done well, but going forward, given that um, there is a lot of uncertainty about how deep the slowdown in the global economy is going to be. And we cannot deny the fact that if the global economy has a deep slowdown, even the uh, domestic economy will get affected. So if, let's say, global GDP growth comes down to 2% or below, which is believed to be a recessionary kind of scenario, then India's growth will also get affected, in which case you want to be in a bit of structurally good companies, the companies which have better technology, better management, etc. So in that sense, while PSU banks still deserve a weight in the portfolio, I don't think we believe that it can't be very high weight in the portfolio.
Sure. Manish, talking about homegrown sectors, there is this whole thrust about manufacturing. Everyone's obsessed with this theme in the market. And, two of the sectors that I want to pick upon is defense and railways. I wanted to understand from you, because, you'd have a better sense on this, whether are we reaching the cusp of over-ownership now in these sectors? And would you say, at least in the near term, the best is behind us?
Definitely, I think the in terms of returns, I think the best is behind us because these stocks have done phenomenally well. They came off a base where people or investors were very under positioned in those sectors, and we've really seen that as the top line growth has come through in defense and railways, there's been a massive re-rating of valuations. Now, I do think that there seems to be a very strong policy focus on these segments, and there can be a multi-year cycle. A lot of it is priced in. But I think also one needs to be a bit careful about the government budget dynamics because the government wants to consolidate fiscal deficit. They've said they want to go from 5.8 to 4.5 in a couple of years in terms of fiscal deficit. And if that were to happen in an environment where commodities are weak and nominal GDP is decelerating, see, the government accounts are such that you have a lot of committed expenditures. So if your overall expenditure is going to grow at 7-8% and the committed expenditures also grow at that rate, there will be some pressure on the discretionary expenditure. And therefore, you need to be a bit careful about that dynamics. So if there is too much of deflation globally in commodities, I think you need to be careful about how strong the government spending will be, which directly impacts these kind of sectors.
Manish, if I was to just look at your activity in the market, it appears that renewables is an area which interests you. You seem to have added some names out there. And among the, which side of the renewable story would you log on to? The generators, some of the capital goods provider around it, or the transportation companies like transport towers and all of that? How would you play the renewable piece?
So yes, in general, starting with that overall call of domestic, domestic over global, even in capex, I think very broad-based capex is unlikely to be strong, particularly because a big part of capex is the commodity producers, the upstream players in commodities, so which are basically your oil exploration and production companies, your steel companies, your refining companies, all these segments, which typically are a big part of the capex piece, given where commodity prices are, given what's the outlook on China, it's unlikely that, unlike 2002 to 2008, where we had a very broad-based capex theme, I think it's going to be a bit selective this time. And in that sense, power being a pure domestic good or service is essentially, I think, somewhere where we've seen many years of underinvestment coupled with the fact that you need to transition to a better carbon regime kind of technology, which is renewables. So you both have a demand supply mismatch as well as a big technology shift. And therefore, I do think that there can be fair amount of acceleration in investment in power itself, particularly in renewables. And because renewables generate power more volatility, there needs to be, as we've seen in Europe and other places, that your grid investments also need to go up because you will have power being very volatile during the year or during the day because of renewables. Now, clearly, we will see investments across the value chain. So you can play utilities, you can play the capital goods which cater to renewable power. You can play the transmission and distribution equipment suppliers. You can play the EPC companies which build up these infrastructure. So yeah, there are various pockets to play. I think various funds are playing it in a different way. But the entire value chain, I think, is definitely interesting.
Manish, the other area of the market which seemed to be turning around after a decade of almost underperformance is the NBFC space, right? And the one which catches my attention, you guys have added, is the most bombed out NBFC out of the lot, which was so tilted in favor of wholesale. People had forgotten.
For the viewers.
Well, it's the hint is enough, but it has come back. It has come back. If the quarter gone by is any indication, now their wholesale to retail stands at 50-50. Do you think worst is over for wholesale kind of NBFCs and now they're looking upwards?
Yeah, I guess we slowly have to start building for a scenario where interest rates are going to come down because if you just see the shape of the US bond yield curve, it is so inverted, and while bond yield curves may not be the right forecaster of how interest rates go, I think you have to pay attention to them. So clearly, we are broadly expected to be in a scenario where going forward, US interest rates in a year or 2 years will be materially lower than where they are today. And if that is the scenario, obviously, whatever Fed does, it kind of flows across the world, right? So I think globally interest rates will be lower, 1 to 2 years lower. And the other point is NBFCs, by the definition of being wholesale, are very dependent on liquidity. Now, as we discussed, if we believe that the dollar has already depreciated a lot, which tends to improve liquidity globally, and the medium-term drivers of the dollar, which is interest rate differential or the fundamental value of the dollar, I think they are pointing to a continued weakness in dollar. So liquidity is good for NBFCs. Falling interest rates are good. And the good part on the asset side is the domestic economy in terms of autos or infrastructure. There is very little at this point you can see where you can say that there'll be huge asset quality issues in terms of giving out loans for houses or autos or infrastructure. So you have a scenario where both the sides of the balance sheet are likely to improve. Valuations again, meaning last 1 year they've done well, but again, if you see on a 5-year starting from the ILFS crisis, it's generally been a very mediocre phase for them. So they're coming out of a fairly long cycle of mediocre valuations. So yeah, net, I do think that they present a broad, attractive risk-reward space to play in.
Right. Okay, Manish, so before we let you go, just a quick word on which do you think is the most undervalued and overvalued pocket in the market?
So I think the matrix of being domestic and small cap, I still think is the space to be. I know it's not a very precise answer. The reason why it's not precise is, as I said, that if you're not expecting broad-based global growth, and if you're not going to see Indian growth also surprised to the upside. I think India will be resilient, but if global growth is going down, you can't expect India's growth to accelerate. In which case, in every sector, I think you will have to find the company which is getting market share. So there are a whole host of domestic sectors. But more than saying this sector versus the other sector, I think it's about finding those stocks because the whole sector is not going to grow at a supernormal rate, right? So I think more than a sector, it's first the domestic part, and then within that, finding that small company which can get market share and grow earnings and mid-teens to 20% plus for next 3-5 years. I think that's the best strategy to play.
Manish, great to have you on the show today. Thank you so much for taking the time out.
Thanks for having me.